Sure. Do we need to go back just a little bit on the front part? Yeah. Okay. So we're going to recap the beginning real quick, guys. Commercial finance options in 2021, and I was talking to you guys a little bit ago about some of the acquisitions that we have going on right here in Chicago. 131 square foot commercial industrial warehouse spot that we're going out to look at today. That's why we're here in Chicago at the Kwak Brothers studios. Sam and Daniel, one of them will be joining us live here shortly. I'm thankful for the entire team for helping us out here today. So just props out to the Kwak Brothers, them giving up their studio again for me. I'm in here like a kid coming home from college, stopping by to visit mom and dad to take food off their counters, right? And so here I am again. The Kwak Brothers Studios are generous enough to bring me in, house me for this live, and so we're excited about that. And then after this, we're off to go look at industrial warehouse space, a property that we've been looking at for 3 months, and we'll be bringing to you guys live that we're working out final logistics on. And then the hotel properties, we're buying distressed hotel brands, and we're repositioning them into multifamily. Got 3 of them today, one of them that we're really interested in acquiring, and so we'll be bringing you guys live footage on those as well. But today, commercial finance options for 2021. And so to go back into my story and where we were at, it really took me what really happened was the pivotal point of deciding that I wanted to get into commercial real estate, and I really wanted to play the commercial real estate game. And I didn't know anything about finance options, and I started looking for referrals from people, friends, colleagues, residential people, mortgage brokers, and so forth that could direct me and steer me to the right people. And lo and behold, I landed up finding some really good commercial lenders, and I exercised a lot of different options. But in the beginning, I started simple. I kept it simple because I didn't know anything otherwise. And so if you're watching this, you're sitting back, you want to graduate from residential real estate investing to commercial real estate investing. That's what we're talking about on Real Talk on Real Estate today is commercial finance options for 2021. And so I used a simple HELOC, a simple home equity line of credit, extending a $100,000 line of credit out on my personal residence, took $75,000 of my own capital, and I invested and rolled it into real estate. And in the beginning of my game, I did have to flip some properties. Now, I'm an invest and hold guy. I love investing and holding. 90% of our assets that we've purchased over the last 20 years, I still own today. A mass majority of those are completely paid off, and that's our nest egg, our security. But we still are acquiring real estate, larger acquisitions, good debt, good financing to acquire cash flow and monthly revenue from all of our commercial acquisitions, from our industrial warehouse space, some of our retail and office that we still own today, and our multifamily apartment complexes that we have as well. And now a lot of the name brand hotels, distressed hotel brands that we're working on acquiring. But for you guys today, I want to share with you guys the financing options moving into 2021 to help you guys get started. Now, look, I've exercised a lot of different finance options over the years. But by far, you know, when I first got started, some of the SBA loans, Small Business Administration loans, these are all government-backed loans that are for small businesses to help drive and stimulate small business growth in the United States. And so the SBA 7A is the first loan that I like to talk to you guys about today, okay? And so for those of you guys who are small business owners, and you guys are looking at acquiring real estate for your companies, your business, or as a business, not just for your business, maybe commercial real estate is your business, and maybe investing, you guys are watching this and it is your business, you can create one simple LLC, one limited liability corporation, to be able to go out and start housing a business with one asset. If you have a business, you're looking at acquiring assets and being able to invest in them, the SBA loan is perfect. The SBA 7A loan is an umbrella loan to give small businesses the ability to grow. Now, on that loan, it's a $5 million max cap. So if you're looking at a $20 million apartment complex, won't work for that. But anything $5 million or less, you can acquire through an SBA 7A loan. And so some of the benefits to that is it's a preferred loan. They have veteran advantage loans through the SBA program. So if you're a veteran, ladies and gentlemen, if you're a veteran getting out of the military, men or women, the SBA 7A loan has a specific loan for veteran advantages to be able to give to just that, to veterans. You can take advantage as a small business owner, being a veteran, sometimes, a lot of times, lower interest rates. And these loans are usually 15 to 20-year commercial loans. And the whole point behind them is to stimulate small business growth in America. There's also another type of SBA loan. It's the CDA, the Certified Development Company Loan. Okay, and this is also an SBA 504 loan. So if you guys are taking notes, this is the CDC, the Certified Development Company SBA 504 loan. And it's made for business growth and job creation. When this loan was put together, it was specifically for small business owners, but also small business owners to allow them to grow and expand and create jobs. And so that specifically is the niche point of the CDC SBA 504 loan, is for job growth, job creation. You get a long-term, the benefits of this loan is you get long-term fixed rates on fixed assets. Fixed assets being real estate, number one, raw land. So if you're looking at developing a piece of real estate, or you're looking at building your own facility for small business use, have multi-tenants. Everything that I talk about, ladies and gentlemen, is always about multiple tenants. And I remember having a conversation with a good friend of mine, well-respected real estate investor, entrepreneur, and this gentleman and his father, good friends. I advocate for everything that they've done. I respect them entirely. But one thing that we didn't see eye to eye on was how to take down commercial real estate. I remember sitting back and they would tell me, Jerome, why would you put yourself through the headaches of having multiple tenants in your buildings instead of just having one single tenant? And to my argument back then, I still argue today. What happens if that one large tenant goes dry on you? Then you have no rental income. And so to stabilize my assets, I'd rather put up with 3, 4, 5, 6 different tenants in one building than have one tenant securing my asset. Because just like a single family home, you have one tenant securing that home over the long haul. When that tenant goes dry, if there's vacancy, that asset now becomes a liability. So anybody developing land out there, I always urge you guys, think long-term. Think asset protection. Think about the longevity and the protection of your ongoing cash flow, so that you're not servicing debt, and the stability of your assets. And so anytime you guys are thinking about real estate, think about multiple doors, because multiple doors really is what kept us alive during the 2008 economic crisis, and it's gonna be what's kept us alive and what's kept us moving and kept us thriving during the pandemic. And so knowing that one business may go out of business or may not is too much of a risk factor. We want to make sure that our assets are protected and our assets stay assets and they never become liabilities. When they become a liability, it's when you personally have to start servicing the debt out of your own pocket with capital. So if you guys are taking advantage of the CDC SBA 504 loan, you can buy real estate, develop raw land. You get constructions or renovation loans. So let's say right now you're in a building, you have a property, and you're sitting back going, I would love nothing more than to renovate this building. You can. The CBC SBA loan are perfect for large renovations or small renovation loans, and you can get, again, up to $5 million cap rate on it. And you can purchase it. You can purchase machinery and equipment for long-term use for your business. And you can also even refinance debt. So let's say, for example, that you've had ongoing debt on your business and it's prohibiting your growth. And I just had a good friend, you guys might have seen him, Sean Maloney, and I don't even know if he's okay with me saying this, but I'm going to say the story because I think there's so much advantages here to what he did with some of the small business loans that he acquired. He had started his real estate brokerage, acquired debt on that company at high interest rates off of credit cards and other stuff. And so when one of these SBA loans became available through the PPP plan, what he landed up doing was taking those loans at a very low interest rate at like 1.5%, refinancing all his debt, taking his monthly outlay of servicing that debt down from over a couple $1,000s a month down to a couple $100s a month, freeing up $1,500, $2,000 a month in capital. And I don't know his finances. I'm just using this as a simple theoretical example. And he landed up utilizing that capital now. And I remember him calling me excited. He goes, "Oh my God, I'm going to definitely take advantage of these SBA loans. I'd be crazy not to. I don't have to worry about servicing the debt. I'm going to finance this thing for the next 30 years of my life. It's going to cost me $200 a month. I'm just going to figure that into my cost of doing business every single month. And I don't have to worry about this debt for the next 30 years. And it'll just slowly over the course of time, pay itself off on a modest $200 a month payment versus $2,000 a month. Hence, what the purpose of the CDC SBA loan is for is to be able to take that capital when you refinance and stimulate business growth, job creation. And so utilized correctly by entrepreneurs, business people, and developers and real estate investors, you can take advantage of some of this stuff. Now, I know the Kwak Brothers are in a meeting right now, so I want to make sure I have respect their time. They're going to be coming in and joining us here shortly. But if you guys are enjoying this content and you guys want more content like this, I want you guys to pound that thumbs up button. Give us a big thumbs up. Let us know that you're here. And subscribe to our YouTube channel for more content just like this. Now, conventional lending, traditional loans. This is what most people consider when they're getting a commercial loan, okay? These are bank and institutional loans. These are loans that a vast majority of people utilize for commercial investing, right? So if you go in, you find an asset that you like, you go in and it goes through the full underwriting process through banks and traditional lenders, and these loans are not backed by the federal government like the SBA loans. All the SBA loans are government backed. These are not banked by Fannie Mae and Freddie Mac. These are conventional, it's also known as traditional lending. Okay, now the purpose of traditional, conventional loans are to purchase assets. And assets, like I've always talked to you guys, assets, real estate. And so all sectors of real estate, it doesn't matter if it's industrial warehouse, it doesn't matter if it's retail, office, it doesn't matter if it's industrial, if it's multifamily, it doesn't matter what commercial or what sector of commercial real estate it's in. Traditional financing can incorporate any area of commercial real estate. So open for the vast majority of people and assets. Now, I will tell you guys, especially in times like this for 2021, something to understand and realize is that a lot of the large banks that run the central banking systems, all the JP Morgans, the Merrill Lynch, the Chase banks, all the big guys, and even the small guys, they put market caps on what they're going to lend on the asset class type being the area of real estate they'll invest in to a certain degree, right? So retail right now has been in financial distress. So do you think that bankers are jumping out of their pockets to come in and say, hey, I want to invest in a shopping mall? They're not. So they put a very small budget cap on what they're going to lend on those years that fits their risk factor, because banks are smart. And one thing that you guys have to realize is that I used to think in early years, I remember fighting with underwriters, frustrated because they couldn't underwrite the deal the way I was underwriting, and I'd be so frustrated. And so once I went through the financial crisis of 2008, I finally realized, I said, okay, I get it. Now I know why they're so conservative. I had pressed myself to my max limits to grow. And it did give us the ability to grow. And we grew beyond my expectations. I was extremely satisfied. But what it also did is create a lot of liability for me because I had to service a lot of debt for a couple years during the economic crisis. And I had to find creative ways to purchase more real estate to service the debt that we had created because we had over-leveraged assets, right? And so, hence, the reason I tell you guys this is because the underwriters should be your friends. And if you can't get the underwriter to make the deal make sense, then it shouldn't make sense to you either. There's something that they're seeing that you're not. And so I typically tell people that the underwriter should be your business partner. And you guys should underwrite the deals together. And so when you're acquiring a traditional loan or an SBA loan and you go through underwriting with these folks, one of the big things that you should do is consider some of the liability factors that the banks function on. Because if you purchase based on the financial institution's lending requirements and everything works in favor of that asset, the the liability on that asset goes down tremendously, because they do this statistically, right? They go through, they don't watch who's going to become president. They don't do their asset class based on Republican or Democrat. They do it based on logical business underwriting, numbers that make sense, not based on emotion, not based on politics, not based on anything other than what's happening in the market sector, where business growth is going, where money should be going. They scale risk factors, and so underwriters should be your friend when you're taking down commercial real estate, okay? Now, traditional financing, you can typically finance up between 65 to 85% of the asset. Now, 85%, if you can get a loan-to-value ratio, an LTV, a loan-to-value ratio that you can pick up on a commercial asset of 85%, typically you're picking it up with equity in that property. It's either something that's coming out of bankruptcy, or you have just incredible credit and a great banking relationship, because typically you'll do a 75% loan-to-value ratio, and so somewhere right there in the middle, 70 to 75% loan-to-value ratio. But they will finance anywhere between 65 and 85%, and there's no maximum loan amount. So when we're going after assets like some of these hotels that we're purchasing, because we're buying them distressed, we're buying them right, a lot of them we're buying for under $5 million, right? But the value of these will be well over $10 million on most of these assets once we acquire them, reposition them, stabilize them, renovate them, and then when someone comes in to purchase them, they can't get an SBA loan because it's in excess of $5 million. So they have to go through conventional, hence traditional financing, so bank and lending institutional financing, and so there's no maximum loan amount. Institutions can lend indefinitely to their cap of what they are able to lend on. So if they want to lend on a $50 million asset, they can. If they want to lend on a $100 million asset, they can. There's no restrictions. And typically these notes are anywhere between 5 years and 20 years. Commercial bridge loans, okay? The next loan type to be able to acquire commercial real estate in 2021 is commercial bridge loans. And it's important for you guys to rewind this, replay this, and take notes on some of this stuff. We have the research, we've done the data, we've actually exercised almost every single one of these loan types over the years, and so it's important to understand what's available to you. The biggest reason, I heard this from you guys, this came off our survey, the biggest reason that people will not invest in real estate in general, but commercial real estate, is the number one reason is because their limited beliefs that they cannot get financing on it. And so understand that in commercial real estate versus residential real estate's typically underwritten based on your job, your credit, and you. Commercial real estate, they do look at that stuff, but a very minimal amount compared to the asset class that it sits in. They want to know, does this produce income? What's the asset class? And does it generate revenue? And so the difference between commercial and residential real estate that most people limit themselves on moving forward is because they don't understand the finance options that are available to them. Our country functions on capitalism, business growth, and economics. And so our federal government will lend to allow people to grow and build and create jobs and acquire assets. Lending institutions don't work without you guys. Lending institutions won't build and function in this world without people taking loans. The one thing you guys have to get good at, I've had to get good at, is underwriting deals that make sense. Underwriting deals that have financial viability so that people can acquire assets. So look, the next one is commercial bridge loans. I love commercial bridge loans. This is one of my favorite loans because a lot of times we're acquiring distressed assets that are either physically distressed, meaning that they're falling apart, they're breaking down, or they're financially distressed. They've been empty. They're pushing on bankruptcy. A lot of these hotels brands that we're looking at right now is stuff that was built in the 2000s, after 2003, after 2005. They're fairly new. So they're not physically distressed, so to say. There might be physically distressed aspects to them, but are very minimal. But with what they are is they're financially distressed. So a building that once cost $10 million to build, we can pick up for $3.5 million, $3 million, reposition it, and make that thing worth $10 million again with a couple $1 million in renovations. Now, here's what happens is you take a financially distressed asset to the bank, to a traditional lender, they're scared. They're sitting back going, okay, this does not have the financial means that it once did. It's only worth to us what it's currently doing in revenue. And so the asset may only be worth $2.5, $3 million to them. And so you sit back and go, okay, I need $2 million to renovate. They're willing to put up part of the capital for the investment into the hotel, but I'm not going to keep it a hotel, right? I'm going to reposition this. I'm going to do something different with it. I need to renovate. I need zoning changes. I have stuff. I have expenses. I have stuff I need to do to this piece of real estate to reposition it and make it financially viable. And so hence, one of the big things is being able to bridge that gap between the renovation time of when you acquire the asset and when you actually go in and you reacquire it. I was talking about bridge loans right now.
Oh, yeah?
And we got a special guest joining us
Oh, snap.
right now. So we got Mr. Daniel Kwak in the house,
Hey.
and we'll bring a little bit of insight about some commercial real estate loans.
Nice, man.
So-
So hey, keep doing what you were saying. Keep
Yeah.
going.
So one of the big things I was talking about bridge loans, and I was talking about bridge loans being pretty cool because one of the big things is I was talking about how you have an asset class and you take a financially distressed asset, and one of the big things is sometimes to a bank when you're investing in commercial real estate, and if it's either physically distressed or financially distressed, they'll only lend X amount of dollars on that property. And so what's good about bridge loans is you typically short-term loans, and they help you bridge the gap between where you need to get to. Like, so if you buy the asset, you acquire that asset, and you're able to acquire it. Now there's a little bridge. You need to reposition this asset, similar to what we're doing with the hotels. And we have a couple $1 million maybe that we need to invest into them. Where do we get that capital? We either use our own capital, which most people don't want to do. They want to be able to use the financial institutions, and so bridge loans are perfect for being able to go in and bridge the gap between purchasing the property, renovating the property, until you can refinance it and get traditional or conventional lending and just take it. Now, typically, they're at a little bit higher interest rate, and they're short-term loans, and so there's cons on it, but the pros for the right purposes make the most sense to be able to
Jerome,
utilize
let me
that.
ask you this question, man,
Yeah.
because I see this happening a lot, and you and I are knee deep in real estate.
Yep.
Which is what I love about you, what I love about our relationship. We're not guys on YouTube who just talk about it.
We're living it.
We're living it every single day.
Every day.
So let me ask you this, man. I see this going on a lot, but right now with the state of the economy, what do you think about interest-only loans?
I like interest-only loans for certain things, right?
Yeah.
So I'm a payoff guy. I'm a long-term holder in real estate. Yep. So my whole thing is always trying to pay off the property. But when you acquire assets, and especially in today's day and age, where if you buy things with a lot of equity in them, and you have a lot of upside on them, I will do interest-only loans to keep my expenses low. And so when I'm acquiring a lot of assets in a real short amount of time. I did this back in 2010 when I was buying in Phoenix. I was acquiring properties, but because I had so much what was good debt become bad debt on me because of unforeseen circumstances, I wanted to keep my monthly overhead low. And because I knew these assets were going to grow because we were buying them so distressed and so inexpensive, I was picking up interest-only loans. And so for that purpose, it worked because we were able to 1031 those. We turned about $1 million worth of assets into an $8 million purchase. And so we were able to liquidate all of that interest-only loan, keep our monthly nut low, and it worked in our favor. But now we have an asset that we purchased with that. We would never do interest only on it because we want to pay off that asset over the course of time.
Yeah, and then I think with that said, my friend, a lot of people, especially right now, they're so finance happy.
They are.
And I think you see the value, man, of paying off that mortgage, paying off the real estate. My mentor told me, like, Daniel, if you're looking to get rich, do flips and refinance and leverage yourself every single time. But if you're looking to be wealthy, find ways to creatively pay it off and pay it off sooner. So I'm with you, man. I'm with you.
So that's a good thing. There's good and bad to all of them. That's kind of what I was talking about today, even like with all the different banking options, just to give people options and say, okay, what are my options? Like, because most people don't realize what's available to them. And so the biggest problem is if they don't know what's available to them, they'll never exercise those tools, right? So like if you have a toolbox, and it has a ton of tools in it, and then, one of the hardest things about being a mechanic, and I don't know if people have experienced this, but I'll go into my garage, and 90% of the time, it's not that I don't know how to do something.
Yeah.
It's that I just don't have the right tools to do it. So if I have to pull a piece of something off a car or a tractor or something, if I don't have the right tools in my toolbox, I'm not successful to get in that small crevice to change out an alternator or a battery, whatever it is. You need the right tools. And so having those tools is one of the biggest is one of the biggest things that is needed for most people. And the problem is most people just don't know what those tools are that are available for. It's like French. They pick up a tool and they're sitting back. If you don't know what a crescent wrench is, you sit back and you look at it and you go, what can I do with this? And so it's the tools that they need to know about to be able to help them. So I was going to go into like hard money lending. So we talked about bridge loans, bridging that gap.
Yeah, go into it, man.
But hard money lending, there's good and bad to hard money lending, and I think some people abuse it. I think there's good aspects to hard money lending that people can take advantage of. Hard money lending being somebody that'll lend money to you on an asset that a bank won't traditionally lend money to you on. And typically because either the asset is it's distressed again financially or physically and has no cash flow. So for an institution to lend money on it, the big lenders, Chase, Bank of America, Merrill Lynch, JP Morgan, all these guys, they're not going to lend money on an asset that doesn't have cash flow. It doesn't fit their business model. So where hard money lending comes in great is when you can go in and get lending on it, and again, to stabilize an asset, you don't want to get hard money lenders in long term because high interest rates, extremely high interest rates. Typically, it could be anywhere from 12%, 15%, and they're short-term loans. You want to keep these on short-term loan basis. But these guys will finance 60 to 75% loan to value, LTV, on an asset. You'll have to come to the table with some cash. But they don't care about your credit too much, if at all. And what they care about is they care about the asset. They want to know they secure their money with your asset. So they'll typically take first position on the property so that if you default, that asset becomes theirs. And then they come back in and they can repossess that asset from you. That's what they're holding.
Yeah.
And so one of the big things is being able to get that money. And so for those of you guys that can't get lending on an asset that's distressed, hard money lenders are a great way to position it. What's your take on hard money lending?
You know what I think, man? I think 2021 hard money lenders are going to make bank in 2021. And there's a couple reasoning for that. I don't know if you watch, there's a guy named Ken McElroy, he's really big on YouTube, but he's Robert Kiyosaki's real estate guy.
Yeah.
And so I've heard Ray Dalio say the same thing. I heard Kiyosaki say the same thing. But all of these guys, who've been around the game for such a long time, every single one of them saying that in 2021, debt is going to be the most valuable asset. With the amount of cash that's being pumped out right now. I mean, I've said it on our YouTube channel, and I'll say it to you. I'll say it to a lot of people. I think the Federal Reserve balance sheet's going to hit over 10 trillion this year. Yeah, I really do think so.
I think so. I think it'll hit up to over 10 trillion this year as well.
And they're doing the $1.9 billion or trillion stimulus bill now. Joe Biden is crazy. He's proposing that. Which is how far can we go, right?
I know.
You know what I mean?
I know. Before we become a communist country, our government just
man,
affording to give every American household money.
Yeah, but you look at the idea that the cash, the value of cash is lower than it's ever been. You combine that with the fact that debt is now the new asset. You also combine that with the fact that banks have gotten slightly tighter with their financing requirements.
Yep.
I talked to 5 different banks, in Florida, and they're saying, we're requiring investors to put 25% equity up front. We're not doing anything longer than 25-year amortization. Yep. We want to do 20 or we want to do 25 at the latest. But, throughout history, when you look at when institutional lending institutions tightened and you saw the value of cash drop, a lot of hard money lenders made a lot of money.
Sure.
Because, these investors that would still want to finance their deals, because people aren't going to stop doing deals.
No, real estate right now, like I always say, in times of distress is where there's the most opportunity. So right now for investors, people are sitting back and they're always asking, well, what should I invest in? Should I invest right now? And I always tell them, yes, this is where we make money. Between 2009 and 2012, the assets that I had purchased during that time frame is probably responsible for about 60%, I'd say between 50 and 60% of my whole asset base because of where it grew to.
And you probably bought them at double-digit cap rates.
I mean, definitely more than that. I mean, we were doing double-digit cap rates. When I'm saying more than that, I'm saying because I'm thinking double-digit 10%. We bought stuff as much as like 23% cap rates on some of this stuff.
And these weren't distressed or these weren't run down or anything like that.
So in Arizona at the time, there was all the immigration stuff going on, and so there was a big thing about Mexican nationals coming in, and they created a governing law that if you were caught renting to an illegal immigrant, they would charge for each occurrence $2,500.
Wow.
Well, I'll tell you, and I'm not telling you guys to do this, but I'll tell you what I did. I was buying distressed assets, single-family homes for sometimes as low. The most inexpensive home I bought was $28,000, but on average, $30,000 to $35,000, right? Oh. So we acquired 11 of these, plus I acquired a bunch of fourplexes, and it took me 2 years to acquire 64 units. But we were picking these fourplexes up for like $60,000 a fourplex.
Wow.
And so we were picking these things up, but at a time where we could get full appreciated rental amounts on assets. So we were able to go in and rent these homes that we were paying nothing for $900 to $1,100 a month.
Wow.
And they weren't even letting us renovate them. The first properties, we were renovating them entirely. And then all of a sudden they come back and say, no, we got it. And we would give them discounts off their rent, and they would paint the walls. They would do the flooring.
They do everything.
They do everything. And so I was renting to illegal immigrants because, one, morally I thought it was wrong, first and foremost.
Yeah.
So I said, hell with that law. And I said, second, I did the math. And I said, well, shit, if I get caught,
right,
who cares? I'm going to make thousands of dollars. I'm bringing in $20,000 a month, $25,000 a month in rental income. And if they hound me about this and I end up having to pay all of that in penalties, I still win because this went on for 3, 4, 5 years.
Yeah.
So it was a win-win situation for us.
Dang.
Which was cool.
That's
we were able
nice.
to turn those assets.
You still got those homes?
No, we've sold all of it.
Good,
So we've 1031'd them out. We've repositioned that stuff. That turned from one $8 million asset, another $6 million assets. We acquired over $15 million worth of assets with $1 million worth of assets that we purchased.
Yeah. I got a question for you, man. I don't know if you have any more topics that you want to cover.
We were going to go over owner financing.
Looks like I came at the right time, baby.
That's your golden nugget right there, man.
Well, let me ask you this question. I've been dying to ask you this question, man. And I'm sure a lot of people watching, are wanting to know this question. But it's very infamous and very notorious that Mr. Biden, looks like our new president now, whether people like it or not. I thought that Donald did all right as president. I thought he did okay. Yeah. I don't hate him as much as other people do.
I don't hate him as much as other people do either.
But Mr. Biden has notoriously said that he's looking to eliminate the basis, right? The resetting of the basis. When a real estate obviously gets, somebody passes away, and the real estate gets passed to the inheritor, right? The benefactor. The basis used to be reset, but now he's looking to take that away, and obviously that's a big hit. What do you think, man? You think people are going to leave real estate? Do you think people are going to sell? What do you think is going to happen?
No, and I'll tell you why. The smart investors. And so for those of you guys who are right now, you guys are watching this and you're sitting back going, okay, I'm uneducated on this. You need to become a smart investor from the day you get started investing in real estate. Because the only people that this will affect are average people buying a single family rental home. So let's say you're working a job and you have this great idea to go buy an investment property, and it's just a single-family rental home. And you buy it in Jerome Maldonado's name. You go and buy it in Dino Kwak's name. When you pass on, in the asset that you're sitting back going, I'm going to leave this to my children, all of a sudden, now you leave it to your children, they get hit with estate taxes, and now that asset just gets plummeted. You just get beat up financially based on taxes. So one of the big things is the wealthy don't buy real estate like that. That's not the way smart investors buy real estate. So if you learn the right way, look, I'm not an attorney, I'm not a tax attorney, I'm not a real estate attorney, but I've exercised their talents over the years. So in 2006, I spent $40,000 for an asset protection attorney. And some of you guys are sitting back going, oh my God, that's a lot of money. And yeah, it's a lot of money if you don't exercise the tools right. But under the big umbrella and the big picture, it's great because this won't affect me. What Biden does doesn't affect the wealthy.
Yeah.
What Trump does doesn't affect the wealthy. You set up your entities. You buy your real estate under asset classes like an LLC where they're pass-through entities. And then you put those under a trust. And when you put them under a trust, I just become a trustee of my trust.
Yeah.
And then I can move those assets and I just reassign a new trustee to that trust when I die. So my kids can step in, my wife can step in, somebody else can step in and just continue running that whole monster of LLCs and asset classes through that trust, and it never gets affected by the Biden laws, by the Trump laws, by any of it. And you don't worry about it. And so I keep saying this. Politics don't depict the direction of large corporations. Large corporations have a 15-year projection already set in place, in spite of whoever becomes president. They don't sit back and wait and say, okay, we're going to be in a Democratic presidency now. The House is Democratic. The Senate is Democratic. They do business today, yesterday, and tomorrow the way they've continued doing business. They're going to continue doing business because they know the real game.
That's right.
The central banking systems run our country, not the president.
No.
And so as soon as you guys understand and realize that, you guys have a better appreciation of how to invest and how to invest correctly.
That's exactly right, man. That's exactly right. Which, speaking of being a smart investor, my friend, where can they go to? Where can they find you? You know, do they follow your Instagram? Do you have a course coming out? You know, I mean, educate me on what you got going on, man.
So we got the Elite Real Estate Society.
Yeah.
And so you guys can go to eliterealestatesociety.com. We have tons of courses on there. We got new ones coming out. And so one of the things that the Kwak Brothers, I've been spending a lot of time with them, and I've been poaching information on how they built out a lot of their systems. And one of the key elements that I gained from you guys was the research that we've been doing from you guys. And so we've been doing surveys to acquire not what Jerome Maldonado thinks you guys need, it's what do you need? And we've asked you guys through surveys. And so now we've built a whole new program around commercial investing. Those of you guys that are involved in residential real estate and are interested in graduating into commercial real estate investing, but the specific areas. So hence today, financing being one of people's most sought after obstacles, we wanted to create and talk about on your guys' behalf. And so, you know, Daniel, I know that one of the things that you guys specialize in is one of the things that I got started with that helped me in my early years of and I still utilize today, is owner financing and acquiring assets through the means of the owners who currently own those properties, financing the property for you, being the number 6 item of types of financing that you can acquire commercial real estate on. And I think that most people mistake that owner financing only happens in residential real estate, and it doesn't. It happens through commercial and all sectors of real estate. Tell us a little bit about your take on commercial.
Yeah, man. I mean,
owner financing.
Obviously, you got a lot more experience with owner financing, so you know this will be more of a discussion as opposed to just me sharing. But you know, I started owner financing because I had no other option. You know, when I first started real estate, you know, obviously I had negative $187 in my bank account. You know, I had bad credit, and I remember this one time. This story still haunts me to this day. You know, it's like, you know, like remember that bodybuilder who talks about how he used to be the skinny kid and he got motivated. But you know, I remember I had a conversation with a commercial banker, and I still remember him. I still remember what tie he wore, what suit he was wearing. You know, tie like a tie, not tie Lopez. You know, like our
like
friend,
regular tie.
the regular tie. You know what I mean? So. You know, I remember having a conversation with him, and I was 21 years old at the time, 21. And I said, hey, you know, I'm looking to get a loan, you know, because I want to buy my first rental property. You know, I'm looking at this. And he starts asking me questions. And he finally goes, all right, well, tell me a little bit about your financials. You know, what's your net worth? What's your, you know, how much cash do you have in your account? What's your credit score? And after I told him, I remember him laughing at me. And he's like, kid, there's no way you're going to get a loan. Are you serious? Like, don't even walk through our doors. And I was like, really? And so I started owner financing because that was the only option that I had. The biggest myth about owner financing that I see when I look at, you know, whether it's our students, whether it's anybody constructing owner finance deals, the interest always is rather too high, you know? So they think that, oh, owner finance, because he gave me owner financing, I'm okay with a 7% interest rate. You know, I'm okay with an 6% interest rate because at least I got owner financing. Well, you got to change the way that you look at owner financing, because a lot of times when you construct an owner financing deal, it actually is more beneficial to the seller than it is for you.
It is.
You know?
It is. And it's educating them. And I think most people, the thing is, you got to get good at educating them, because one thing that I do, and I still do this today, is that there's capital gains tax. And most people, a lot of owners, they're not real estate investors. They're not going out and they're not acquiring a mass conglomerate of asset bases in the real estate sectors. A lot of them own one piece of property, maybe 2 or 3. And so they're not as savvy as you think. They've just acquired these properties. And so with long-term capital gains, you can offset the capital gains taxes because they're going to land up getting hit. Even if they've owned that property for over 2 years, they're still going to get hit with 20 to 30% capital gains, depending on where they sit into their tax bracket. And so they could sell the property. They only have to pay taxes. Let's say you go in and buy $1 million property and put $100,000 down on it, or $150,000 down. They're only taxed on the down payment amount that year. And then they're only taxed on the payments that you're making to them. And so the other $850,000, $900,000, they're making interest on it. So they're actually making additional revenue on the property. And so if they do it for 5 years, 10 years, whatever it is, if they land up financing it for you at 5%, 10 years, they're making another 50% on their asset class over the 10 years. Plus, when they finally get paid out, it offsets those capital gains taxes to that point in time. And so it's advantageous for them. But most of them don't know that, so you have to educate them.
You do.
And you have to explain that stuff to them because it works magically for tax purposes on their behalf.
Oh, 100%. And a lot of these landlords, in my experience too, because what I used to do, I used to target a lot of older landlords. Because I knew it was the older landlords that would benefit from seller financing a little bit more because they've owned it for a long time, they've depreciated out the building, and they're worried about not only the capital gain tax but also their ordinary income tax rate as well. And so one of the things that I loved that most people saw as a benefit too is that you got to remember, Jerome, a lot of these guys, they've owned real estate for 25, 30 years. Their stories, my dad used to own this building and, he passed it on to me and, I've owned it now for 30, 40 years and whatever. And, my kids don't have any interest in real estate. How often do you hear that, man, when the landlord goes, oh, my kids are not interested in real estate? And we're just like, what do you mean? Like, what are you talking about? Those kids don't know what they have, But a lot of these guys, they're used to getting that monthly income.
And those kids, sometimes those kids are 60 years old.
Yeah.
It's funny. My first owner finance deal was one of those kids, and he was like in his 60s, and he was an operations guy for the laboratories down in Albuquerque, and he inherited a property. His father was in his early 90s, passed away, and inherited the asset. And he goes, "I've worked in an office my whole life, Jerome."
Jeez.
He goes, I don't know anything about real estate. I don't want to know anything about real estate. This is just a burden to me. Please take it off my hands. And so he landed up going in, and I educated him on owner financing. He owner financed it for me for 5 years, and in 3 years we refinanced it. But it was like a win-win situation. So some of those kids aren't just kids. Some of those kids are 60 years old.
Sure. Yeah. Oh, absolutely. So, you know what I mean? And they're like I said, they're used to receiving that monthly income.
They are.
Because for 30 years being a landlord, you're used to having the rent checks come in every month. So for a lot of these guys, and 80% of these guys I talk to that are older, that I pitch them owner financing, they already have a lump sum of cash. They've already got millions of dollars sitting in the account, and they don't need any more money. If anything, they're looking to minimize their risk, and they're looking to travel, do more things. So these guys don't mind having a monthly payment come in. Just instead of a rent payment, now it's a debt service payment.
It is. And you'd be surprised if you educate people how many people would consider it, and getting creative. And what's cool is you can mix and match some of these. And so where if you're stabilizing an asset, maybe even getting an owner finance deal, and then if you have renovations, you can go in and get a bridge loan or a hard money lender to finance it. Hard money lenders typically not, because they want to take first position, and typically when you owner finance, you want to give the owner of the property, the original owner of the property.
Speaking, because I know you got subject to in there as well, but speaking of subject to, you could do a seller carryback mortgage. Where you could do a subject to transaction up front, and then you can also attach a seller carryback mortgage in the back end and have an owner financing note after that mortgage is paid off. That's another option.
So for those of you guys who aren't familiar with what a subject to loan is, it's a loan that you assume essentially. So it's subject to the original terms of the loan of the original creator. So let's say Billy Bob, who owned this asset, this warehouse that he purchased in 1985, came in and he got this loan. Then he refinanced it again. He has this loan that's been ongoing. And now he's at a point where he's like, look, I'm done. I'm done. I want to get out of the real estate game, but I have this loan. I got to pay this loan off. And so you go in, you say, okay, what are the terms of this note? And you read the terms, you read the notes, and you say, okay, I can service the debt on this. And even if I service the debt on this, I still have X amount left over that is cash flow for me, or not. That's where you get the bridge loans. And so you go in and you assume that note subject to the original terms. And so you can still deed the property over to you with what's called a take-back deed. So that way, if you don't facilitate and honor the terms of that note, the deed goes back to the original owner, but you still, the property essentially, as long as you're good on your terms, is deeded to you. So it's secure, the asset's secure in your name, subject to you fulfilling the necessary requirements of that original loan. So you're basically taking the assumption. And typically, the banks don't typically care about your credit and stuff at this point in time. They really care about the asset, because it's really the asset itself that's actually protecting the loan itself.
Especially if it's a bigger commercial building.
Yeah.
You know, the banks always look at more the deal
asset.
as opposed to, you know, the person anyways.
So,
Yeah.
so which is great. So those subject twos are great opportunities. And so, Daniel, I love having you come in and bring your insight on this stuff. And I know that we encroached on a little bit of you guys' time. You guys are getting ready to go live here.
Yeah, we are.
Now on the Kwak Brothers
I want you to
Studios
join
on
us,
Kwak.
by the way, on the live show.
Okay.
Yeah, it's going to be me, you. We got Nick over there. He's got his mic and camera. Sam's going to be here. We got a lot to talk about today. We're going to talk about the stimulus that Joe Biden's passing on. We're going to talk about the housing market. And I've got my predictions for what's going to happen with the housing market.
Yeah.
We'd love to have to hear yours. But let's talk about. You want to talk about the event?
Yeah, let's talk about the event, because we
Okay.
have on the 26th, right?
The 26th. It's a Tuesday.
January.
Yeah.
So we got Ty Lopez coming in with us. I just got final confirmation from him last week that he's going to be speaking at the event. So we're excited about that. You guys have probably seen the posts that we've been putting out on social media. And tell us a little about this. Is your event. I don't want to take away from you, man. Tell us.
Well,
a
we're
little
doing
bit
it
about this.
together. You know what I mean?
Yeah.
Which is what makes me happy. Guys, Jerome, this guy's a brother from another mother. You know, we're gonna do a lot of business together. You know, for years to come. And he's become so much more of a friend than a business confidant. But here's what's going on with the event. I've heard it. Jerome's heard it. We've all heard it. Everybody's wondering what's going to happen to real estate in 2021.
Yep.
People for years. I remember back in 2016, people were saying, "Oh, there's going to be a crash coming. There's another one coming. I'm telling you." And then there's other people who are saying, "Oh no, there's not going to be a crash. The buyer pool will offset the low inventory that's there right now."
Yep.
So there's been a lot of questions, speculation. For me, it's time to hear from the experts.
Yeah.
When I see guys like Jerome, when I see guys like Ty, and we added another speaker actually recently, a couple of days ago. So we got my buddy Steve Hamilton, who's a tax professional.
Yep.
He's going to be talking about, hey, how to structure your business and your tax structure for 2021.
Yep. So what's the name of the event? Deal Closers, right?
It's Deal Closer Live.
Yeah.
So the topic, the theme is going to be how to make money in real estate in 2021.
Which is cool, because we're still closing deals. In fact, we're right after I leave here, we're going to go in. We're a 131,000 square foot warehouse.
Yeah.
We're deal closers, baby.
Deal closer.
We're doing it. and
Jerome's
we're
a deal
working on.
closer. You got to be like Jerome. You got to be a deal closer.
It's got to be a little crazy sometimes,
Right.
But hence it gets you places.
That's exactly right. But that's the event. So we have 4 speakers. We're giving away some stuff as well, and we got some exciting opportunities. The link is dealcloserlive.com. If you guys want to get your tickets, dealcloserlive.com. It's a very simple link. Get on there, get your ticket. It's going to be on Tuesday, January 26th. It's going to be myself, Jerome, Ty is going to be there, my buddy Steve. And again, the theme is how to make money in real estate in 2021. Right? We're going to lay all the myths to rest. A lot of people saying, Jerome, how can you do real estate right now? Look at the state of the economy. Look at them. And Jerome says, no, I'm doing it right now.
Yeah, we're going to get wealthy.
He's closing deals right now.
Wealthier right now.
Right.
Those of you guys can piggyback a lot of this stuff.
Yeah.
And people ask, they'll say, why would you guys teach this stuff? Do you guys want competition in the market? What do you say to that stuff? Because I have my take on that when people say that. I sit back and go, there is no competition, because most of you guys watching this will never take action. I'm sitting back going, come along with us. We need more of you guys making money so you guys can invest in some of our bigger deals.
That's right.
Yeah. And so that's our motive, in all honesty, is that let's make you guys some money so you guys can come invest in some of our bigger deals.
Yeah.
Let's bring you guys along with us.
That's what I'm looking for, man. I'm looking for that one dude who's going to take what we say and he's going to blow it out.
Utilize it.
Yeah. That's what I'm looking for.
Dude, I'm excited for it,
Hey,
man.
this is going to be good.
I'm excited
man.
to have it.
Yeah.
Yeah. Well, hey, thank you guys for joining us. And I want you guys to play rewind. And remember, if you love the content that you guys saw today, I want you guys to pound that subscribe button, give us a big fat thumbs up on YouTube, and join us for more content just like this. Next Friday, real talk on real estate. We look forward to seeing you guys then. But until then, you guys go out and have a blessed day. Thank you and God bless.
Nice.
Cool.